Hi, good morning, everyone. Today I'm going to record a quick video to explain to you about the midterm exam question number 31. So many of you get it, how to work on it, but some of you were still struggling with how to do the calculation, okay? So I'm going to use the exam version 4 to explain how we're gonna do the calculation. And in this exam, I generated 8 versions of exams. So basically these numbers, okay, 65, and all these numbers on the table, these are randomly generated from computer, but the question is identical, okay? Everything else is the same. You just start working on different numbers. So basically for all the questions in the 8 different versions, in the year 1, it's profitable, okay? In year 2, okay, it's an onerous contract, okay? And year 3 is profitable, okay? So it's fair for everyone. It's just different number you want to work on, okay? So you're gonna probably need the same kind of formulas, right? So, this is the way how I want to reduce the possibilities of plagiarism among students. At the same time, we can make it fair, right? The questions are totally identical. The only difference is the number, is a calculation, okay? So I just don't want people to copy other students' answer, right? So, so I use Python to generate. I can generate one question for each student, right? So final exam, I may generate a version for every 2 students, right? In the final exams. So okay, let's take a look at this question. So this question is a XS Incorporation is a builder of large digital networks. In the midst of the high-tech euphoria, the company bid and won a 65 million contract. So that's the fixed price, 65 million, to build a network for the country of India. Details on the project over the 3 years are as follows, okay? So year 1, year 2, year 3, okay? And then they have the cumulative cost incurred at the end of each period, additional cost estimated, okay, to complete, and the amount of invoiced and the cash collected, okay? So the first question is calculate the amount of revenue, cost of goods sold, and the gross profit or loss to be recognized in each of the 3 years. The company used the percentage of completion method to account for long-term contracts. Please show your calculation, round any percentage to the nearest 2 decimals, okay? So let's take a look at the first year, year 1. So we need to calculate percentage of completion, right? So this is calculated, we're using a cost to cost approach, right? So what's the cost? The first cost is cumulative cost incurred, and then divided by total cost, total estimated cost, right? Okay, so that's the 2 cost numbers. So in this case, for year 1, at the end of year 1, okay, so the cumulative cost is 22, okay. So what is the estimated total cost year 1, okay? So that will be the cost already incurred, 22, plus additional cost to complete, estimated at the end of the year 1. So that would be this number, right? That would be 42, right? That's the additional. Okay, so this equals 22 divided by 64. Okay, so that's the percentage of completion. So I want to calculate what this percentage is. So I need to use a calculator. Okay, so the 22 divided by 64, right? So that equals 34375, 3438. Okay, because we keep to the closest, the 2 decimals, right? So 34%, 34.38%. Okay, so that equals 34.38%. Okay. So the revenue, this is the first year, right? This first year. So you can do this cumulative revenue at the end of year one. So that will be equals to 34.38 times 65 equals. So what is this equals to? Just give me 1 second. 35 times 65, 22.33, right? 22.33. 22.33 million, right? So that's the cumulative revenue to be recognized, should be have been recognized at the end of year one. What about the previous, right? What about the revenue recognized before? Well, this is the first year, so revenue recognized previously is 0. So year one revenue equals 22.33 million minus 0 equals 22.33 million, right? And then the cost, this is revenue. Year one cost equals, well, this is the first year, so the cumulative cost incurred, that's the that's the year one cost, right? Because there's no cost before year one, right? So whatever the cumulative cost for year one, that's the actual cost for year one. So that's gonna be 22 million. Right? So it's easy, right? Gross profit equals revenue minus cost. So 22.33 minus 22 equals 0.333 million. So it's a little bit of revenue, right? 0.003. So we're done with year one, right? It's easy, right? We're done with year one. Year two. Year two, okay? So year two, let's take a look at total estimated. Let's take a look at cumulative cost. Cumulative costs incurred at the end of year two will be higher, right? Over time, this is accumulation. It's going to be higher, 43. Total estimated cost would be cumulative costs incurred plus additional cost to complete. So that will be 43 plus 24, right? Here's 24. Right. So that would be 67. Okay, so here there's a problem, right? Because 67, that's the total estimated cost, is higher than the fixed price, 65, right? So this project is expected to incur a loss, right? A loss of how much? 2 million, right? $2 million loss. 65 minus 67. That equals -2. So this is an onerous contract. Remember, if it's onerous contract, right? Up to this date, the cumulative revenue or loss has to be the 100% of loss. The idea is you have to recognize the full amount of the loss, right? Because you deliver the bad news as soon as possible, right? You can delay the good news. If it's a profitable contract, you recognize revenue based on percentage, right? You don't recognize 100% revenue. However, if it's a bad news, right? Up to this date, right? The cumulative revenue, the loss, has to be equal to the project loss. So that means the the profit, right? The cumulative profit. Cumulative profit at the end of year 2 has to be negative 2 million, right? Because, right, the accumulation of the profit up to this point is what you should recognize 100% of the onerous contract loss. Okay, so in the first year, you recognize the revenue of first year profit. The first year you recognize a profit of 0.33 million. So in order to make the accumulation of the profit to be negative 2 million, so the year 2 profit has to be negative, okay, loss. The year 2 loss has to be 2.3 million. Okay, so the first year you recognize a profit, 0.33. The second year you recognize a loss of negative 2.33. Together, that would be a net of negative $2 million loss, which is 100% of the loss of this owner's contract at the point of this time, right? So, so you know the loss. Okay, so let's still calculate the percentage of completion. So that equals 43. That's the cumulative cost incurred divided by total expected cost, 67. So that equals 43 divided by 67. 43 divided by 67. 6418. 6418. Okay. 6418%. Cumulative revenue. So that would be 64.18 times contract price, which is 65 million. So that equals okay, so just give me 1 second. So 0.6418 times 65. 4172. 4172. So that equals 4172 million. So that's the cumulative revenue. What about the year 1 revenue? Year 1 revenue is, we have calculated that, year 1, 23.33 million. So year 2 revenue will be 41 times 72 minus 22.33. So that equals, that's 939, so 1939. Okay, 1939 million. Okay, so that's the year 2 revenue. Year 2 cost, year 2 actual cost. So that equals cumulative cost, which is 43, minus the previous cumulative cost, 22. Okay, so that's gonna be 21 million. Okay. So if you just use the revenue 19.39 minus 21, you get a negative, a loss, right? A negative $1.61 million loss, right? I think that's right. Yeah, negative $1.6 million loss, right? But the loss should be, this loss should be, remember, 2.33. So the difference, that will be the expected future loss, okay? So expected future loss, okay, at the end of year 2, that's gonna be, okay, so that's 27.72, right? $0.72 million loss. So this one, this number can be calculated in a different way, right? So the future percentage completion, future percentage to be completed. So that's 1 minus 6.64.18%. So that would be 35, right? 35.82%. Okay. So then the total, the expected loss, expected future loss equals this percentage times total expected loss, which is 2 million. So that's what you get. You have 0.71, sorry, 0.70, okay, 164, right? So this is approximately $0.72 million loss. Okay. So that's year 2. Okay, that's the year 2. Year 3 is the last year. The total revenue is the cumulative revenue recognized is 100%, which is 65 million. And then for year 3 revenue, you use the 65 million minus this number, 41.72 million. That's the cumulative revenue at the beginning of the year. 65 million is the cumulative revenue to be recognized at the end of third year. And the 41.72, that's the number for the end of the year 2, which is also the beginning of year 1, right? So the difference would be just the revenue recognized for the period of year 3, right? So this equals to, okay, so if that's gonna be 24, so 23.28 million. And the year 3 actual cost, the difference between the two cumulative cost number, right? So that would be 61 minus 43, right? So the cumulative cost, total cost, cumulative cost is 61 minus the previous cumulative cost. That increase is the actual cost incurred for year 3. So this is going to be 18, right? Million. So the difference is 23.38 minus 18 equals 5.38 million. And don't forget, reverse. You're going to reverse the expected loss because you recognize the expected loss of 0.72 million in the prior year. The next year you have to reverse this, right? So you reversed it, okay? So then you have to add 0.72 million. And what about the new assessment for the future expected cost? That's 0 because year 3 is the last year. There's no future, right? So you minus 0, so that equals, so this is gonna be 6, 0, okay, so that, how is it? 0, 1, 6.1, 6.1 million. Okay, so this is the number you recognize. In the first year, you recognized 0.33 million. That's your profit. Second year, you recognize, okay, that's the year 2, right? Year 1 is here, 0.33. Okay, so year 2, the loss you recognized, that's gonna be, okay, let's take a look here. This one, okay, 2.33. And year 3, you recognize the 6.1. Okay, you recognize the 6.1. Is that right? Just wait for a second. 0.33, 2.3, 2.33 million. Because in total that's 2. Okay, but how come this one is 6.1? 0.2. Okay, so 65 minus 4172, so that's 23.28. Don't read. Oh, it should not be 6.1. It should be 6. So just give me 1 second. So this one, so this answer is here. The revenue is 3.35. So 0.05. This is about the rounding, right? It's about the rounding. I got 22.33. And this number is 22.35. So it's about the rounding. And this number is, the revenue is 1937. So mine is 1939. I think it's the rounding problem. So the reason why I have the numbers is a little bit off, that's because of the rounding, okay? But the approach is the same, okay? The approach is like this. So when I add this together, okay, this number ideally should be 6, right? Should be 6 because in the end of the day, the total revenue is 65, total cost is 61, so the difference should be 4 million. So by this point, at the end of the year 2, that difference is 2 million loss, but it should be a 4 million revenue. So therefore, in the year 3, you have to have a $6 million revenue, okay? But 6.1, so I think it's about the rounding, okay? It's the rounding issues here. Okay, so that's this question. For the calculations, for the journal entries, I think it's pretty straightforward. I think many of you have done a great job on this one. Okay, so that's it.